Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. Our All About Crude Oil special brings on two new experts. The first one is Doug Kass, founder and president of Seabreeze Partners Management, and Leonard Weiss. He's the senior vice president of investments at Weiss Wealth Management. Gentlemen, how you doing this morning?
Very, very well, Joel. Thanks for having us on.
Okay.
Thank you, sir.
All right, Doug, let's start with you. I mean, everyone's talking about $50 crude. You know, where's it going? You hear pundits talking when the big boys get out, it's going to 20. Got a lot of people trying to pick a bottom in here. Just give us your historical perspective here on $50 crude.
Sure. Let me start by issuing a caveat to you guys. Unlike Leonard, I am not a specialist on energy or the price of oil. I just observe as a generalist. On Real Money Pro in the Street, I wrote a piece in early October in which I connected the dots, and I basically said that the dissolution of OPEC and materially lower oil prices was in the cards, which was a real outlier view because obviously the price was much higher. The way I look at this whole issue is that OPEC, which was established back, I believe, in 1960, really didn't become an impactful force in the market until the mid-1970s, when its policies caused a fourfold increase in the price of oil, I think from $2.60 to about $11. It obviously caused a serious global recession and a devastating bear market in stocks. They've been operating as a classic cartel, utilizing artificial means to raise the price, and economic theory teaches us that cartels are transitory. Even though it's impossible or difficult to imagine a world without OPEC, powerful forces to me were coming into place back then, which suggested that OPEC's days were numbered, and that this lengthy period of almost 55 years of the pain of inflated energy prices was coming to an end. So that's my, I can go into the reasons why I concluded it, but as to your specific question, I find that most people don't have much rigor in the forecasting of any commodity price, and energy in particular, and I certainly don't. But I just look at history, as Mark Twain used to say that history rhymes and may not repeat itself. And over the last 3 decades of the price of oil has basically made 6 key lows. This is the 7th, and all were followed by U-shaped recoveries in prices of the commodity, which took on average about 2 to 4 months of up and down action before heading much higher. But it's important that in all 6 cases, oil prices had double bottoms, where the low was retested back in 1986, 89, 93, 94, 98, 99, 2001, and 02, and finally in 2008 to 2009. So my best guess, if history repeats itself, and I'm not doing any econometric forecast here, is that we'll get a test of the recent lows of about a month and a half ago.
Leonard, give us your historical perspective on oil.
Well, I have to be honest, I don't have a historical perspective on oil because my emphasis has been on the master limited partnership side, where we're mostly processing and shipping. So I don't really have a global view about oil, but I agree with Doug that history says that oil falls very, very quickly. Within a few months or a year's time, most of that has been recovered because oil has an intrinsic value, a quantifiable need. It's not a bad loan that goes to zero or a .com company. So I'll agree with Doug that the history says the price of oil should languish for a few months and then begin a slow and steady bull market.
I do think that if we look for a second, looking at a historic perspective, because that's basically the only thing I can offer since I'm not a specialist, it seems to me that OPEC has wandered Leonard into this perfect storm for 5 or 6 reasons. Firstly, we obviously have the growing influence of the U.S. on energy production. The U.S. Through hydraulic fracking has become a major oil producer. Our imports have fallen. helped by secular efficiency in consumer energy and consuming energy. Secondly, we have this subpar global economic growth, which I've been talking to Benzinga a lot over the last year and a half, which has been influenced by structural headwinds, and it's served to reduce oil demand, especially in Europe and China. So remember that oil is priced in U.S. dollars, and the dollar rise has made oil more expensive and has moderated consumption. The third issue about this perfect storm is that leading suppliers have raised production. We have a few major producers who are motivated to increase production and steal share rather than cut production, which is the usual OPEC strategy in times of slack demand. Saudi Arabia did it a month and a half in early October, etc. Fourthly, we have Russia's economic woes. Russia, which is not a member of OPEC, has deepening financial troubles, and oil is its principal export product. Its currency is in a rapid decline, and its oil is priced in U.S. dollars, so logic suggests that Russia will desperately raise production. Fifthly, others have issues. There are three producers with excess capacity that have issues. Iran is an example. If the Saudis surrender share to them, it would help their cause, even though it seems unlikely. And then we have this Arab Spring, which has left Libya in shambles, and it's producing in order to rebuild its infrastructure. And the final thing is Venezuela is a wild card. Venezuela in the past, and OPEC could usually be counted on to withhold production, but due to its inflation and recession, which is deepening, it's unlikely to happen.
Doug, you're a money manager. Can you tell us what you're doing with oil right now?
Well, I'm doing nothing. I was short oil stocks for some time, reflecting my view of the dissolution of OPEC, which was an outlier view. Now I have no position. I've covered my shorts, and I expect there will be a buying opportunity if there is a retest of the low of a month and a half ago in the price of oil.
Leonard, let's go to you, and let's get a brief description of MLPs and why they may be a potential way to play the oil market.
Well, MLPs, which stand for Master Limited Partnerships, are listed partnerships just like stocks that involve in fossil fuel exploration, processing, and distribution to retail markets. Generally, the MLP market is divided into three segments. The upstream segment, which is about development, the midstream section, which is about transportation and storage, and the downstream sector, which is a distribution to retail markets. It's best to look at the MLPs in the three different segments because different opportunities and risk-reward ratios exist within the different subsectors.
And could you just give us examples of one in each sector so I could pull a chart up for our audience?
Unfortunately, I'm on the public side, and FINRA restrictions forbid me to actually mention individual names, but I can tell you that we favor the midstream sector, and we favor companies that have very strong balance sheets that are investment grade. We prefer the midstream partnerships because they act most like a toll road. They never really own the commodity. They merely own the transportation and processing and are normally on fee contracts. So they have volume risk, but not necessarily commodity price risk. And then lastly, we really research down deep to look for a distribution growth, because we believe that distribution growth is the main driver of the MLP marketplace.
And
Leonard, what are some of the outlier risks to your thesis?
Well, some of the outlier risks involve mostly the upstream sector because they're actually involved in pumping oil fields that have already been drilled out and then hedging that price in the marketplace. 2015 and to some extent 2016 aren't a big problem because they've already hedged this product back when oil was $90. The biggest risk in the upstream sector is the inability to sell oil for 2017 and 2018, which really, really impacts EBITDA and also impacts balance sheets.
Gotcha.
what about interest rates? This is kind of an interesting...
I was just going to ask that.
Well, you can't really know the future, of course, but I will point out that in the summer of 2013, the 10-year Treasury bond rate doubled from about 1.5 to 3, and the Alerian MLP index rose at the same time. You know, MLPs are not like fixed income. They have the ability to raise their distributions. And as interest rates rise, distributions are rising also. So that kind of mitigates some of that interest rate risk.
Okay, and let's just talk about some of the big oil companies. Doug, I know you said that you were short of a few of those, and that you covered your shorts. Looking like ExxonMobil, Chevron, they're just kind of hanging in here. Are you just looking for like that panic flush bottom, where just to get out? Everyone is trying to pick a bottom here. Do you have a technical level? Are you basing it on fundamentals or earnings? Because just looking in the backdrop, Mr. Buffett, he's out of ExxonMobil.
Yeah, I'm looking for the only interest I'll have is if there's a panic, if the price of crude drops back to the low 40s, and we'll likely see a panic because I think there are a tremendous amount of bottom fishes who are trying to find the bottom in this energy group.
And, of course, the lower cost of oil does have positive benefits on different parts of our economy. Ron and Sana was talking about the restaurant industry. Do you think that there are other segments or sectors of our economy that are going to benefit from lower oil?
No, I actually think that net, it's probably neutral to slightly negative. I disagree with those that think it's that the price of energy is going to provide an incremental boost to economic growth. We certainly haven't seen it yet in today's GDP figures. And actually, one of my 15 surprises for 2015 on TheStreet.com and Real Money Pro was that lower oil prices result in lower than expected real growth in the domestic economy.
And Leonard, going to you, I mean, our MLPs. I mean, we are such a low volatility environment. Do MLPs really fit that bill as low volatility?
Well, if you look and judge 2014 as your only data point, the answer would be no. They're very volatile. But if you go back over 5 or 10 years, you'll find that they're not only low volatility, they've also been a very low correlation to the S&P 500. So as the price of oil settles down, we would expect the MLP group or the Alerian MLP index to kind of reassert its more tortoise-like action than the hare-like action we saw last year.
And Doug, I'll go to you first on this one. Strong dollar, holy smokes! And is that gonna play a factor at all in with crude oil prices and how it affects overseas countries and the?
It certainly has historically, and there's no reason not to expect it to continue.
And Leonard?
Yes, sir.
As far as the U.S. dollar, I mean, your investments are denominated in U.S. dollars, so a good strong dollar is good for your MLPs.
The stronger dollar or a weaker dollar is not as important to the MLP markets as they are to the crude oil markets because, again, especially in this midstream sector, we work off of fee contracts. Think of the pipelines as cylindrical real estate that basically get a rent whether they sell the product or not. So the value of the dollar really doesn't come into play when your primary business is just moving, storing, and refining someone else's product.
Doug, you said you were short oil for some time. Are you playing energy at all right now, perhaps dipping into solar or some other alternative energy?
I have absolutely no exposure at all into the energy group right now.
Okay. Alternate energy, the solar stocks and things like that. Hands off on that as well?
Never been my thing.
Okay.
I've always felt that the valuations were too high relative to the prospects.
Right, and who knows when all these subsidies and things for the federal government run out, what's going to happen to those stocks.
You know me, I'm apt to short valuation rather than go long it.
Yeah, and it's done you well. Leonard, just final thoughts here. How can investors learn more about MLPs? When should they consider putting them in their portfolio, maybe as a substitute for something else?
Well, yes, we've used the MLPs as a substitute for bonds because we feel that bonds have such a forward-coming risk in price. MLPs are more directed for people that want income before growth. If you want growth before income, that's what exploration and production companies are for. And if people just have any questions about this very focused investment, we have a lot of content at weisswealthmanagement.com, and people are free to view what we've written. Our phone number is there. We would field any questions from any investors.
I would conclude by saying that before one gets into the long energy stocks, consider how telling Warren Buffett's disposition of his large ExxonMobil stake was. As you know, Warren is a forever type of guy, and he probably had some pretty damn good reasons for exiting that position.
Doug, where do you think, if you're not a fan of energy, where do you think is the best place for investors to be putting their money right now?
I think you have to adopt a risk-averse view towards the market. I think the chasm between the real global economies and equity prices has ever widened in the last few months. And I continue to see a malinvestment intersecting with economic reality in 2015, 2016. So I'd be very cautious, and my favored asset sector would be closed-end municipal bond funds, which still trade at about a 6% discount to net asset value and provide roughly 6% non-taxable returns, which are slightly levered.
We've been on the line with Doug Kass, founder and president of Seabreeze Partners Management, and Leonard Weiss, MLP expert and senior vice president of investments at Weiss Wealth Management. Gentlemen, thank you very much for your experience, perspective on the oil market. Great information for our customers. We hope to have you on again soon.
Thank you so much. We'll be glad to come back anytime.
Thanks
okay, thank you.
Thank you. Bye-bye now.